Hey everyone, welcome back to the channel. My name is CJ, and today I want to talk about my 5 key takeaways from the recent Berkshire Hathaway annual letter released for the fiscal year of 2020. I'll dive straight away into my key takeaways, and then I'll finish up with why I think these annual letters are so valuable. There will be timestamps in the video description if you want to jump around to any point in this video. This video will focus on broader business and investing principles that we can learn from Warren Buffett's annual letter, viewed through the lens of a Berkshire Hathaway shareholder. Before we begin, please subscribe to the channel if you want to keep up to date with more investing videos like this in the future. Okay, let's get into it. First up, Buffett talks about how he views his portfolio of stocks as a collection of non-controlled, partially owned businesses as opposed to investments. Thinking of his investments this way aligns his long-term goals with the long-term goals of the company that he's investing in. As an owner, he expects to receive a portion of the company's future earnings. So for example, when he invested in Apple, he probably didn't consider whether it was on the top buy list for some Goldman Sachs analyst, or because there's been a lot of price action or volatility in the stock. In all likelihood, he probably tried to put himself in the shoes of an owner of Apple and tried to figure out what his share of the pie would be many years into the future. Now that you framed yourself as an owner, you have an obligation to understand the business that you now partially own. Personally for me, and probably for Warren Buffett too, I wouldn't take a stake in a business if I didn't understand how that business made money or the other fundamentals of the business. It's also likely that Buffett, as an owner of the business, would be in the right frame of mind to ask himself whether or not he would be happy to purchase more shares at the current price. All in all, being an owner instead of just an investor helps you ask better questions about the business. Buffett says that while investors don't control the operations of a company, they do share in the long-term prosperity of that company, which leads me to my next point. What I just said may have gone in one ear and out the other, so let me repeat it. As investors, we don't control the operations of the business, but we do share in the long-term prosperity. That's right. The great thing about being a passive owner in a business is that we are not responsible for the operations of the business. We put money down and let management do all the heavy lifting. What a deal. Of course, we need to be mindful that management is capable of producing favorable outcomes in the future. But the great thing is we do a lot of research up front and then hand over the responsibility. It's a one and done type of situation. Buffett says that owning a non-controlling portion of a wonderful business is more profitable, more fun, and is far less work than controlling the operations of that business. I'll have to take Buffett's word on this one because he has a ton of experience owning 100% of a company. I'm still in the position where I can only partially own wonderful businesses. But even if it were less profitable to partially own businesses, I would still take the route of far less work any day. As investors, we're privileged to give money to brilliant entrepreneurs, sit back, let them do the hard work, and we reap the rewards of their labor. I'm content to sit back, try to spot opportunities, and then let the management work their magic on my behalf. I'll end this section with a quote Buffett shared from Ronald Reagan, which goes, "It's said that hard work never killed anyone, but I say, why take the chance?" Real quick, if you're enjoying this video so far, please like the video and subscribe to the channel so you can stay up to date with my future investing videos. Okay, back to my key takeaways. Next up, I want to talk about the power of retained earnings. It's a topic Buffett mentions quite frequently. Retained earnings is the sum of cash left over from the business's profits after dividends have been paid to shareholders. So think roughly net income minus dividends equals retained earnings. So Berkshire Hathaway directly receives dividend income from their investments, and they have to report this under GAAP. But where do the retained earnings come into play, and why does it benefit Berkshire Hathaway? Well, these retained earnings are the future growth engine for the businesses that Berkshire invests in. A company can use retained earnings to grow their core business, to buy other businesses, they can pay off debt, or they can buy back shares. To top it all off, the retained earnings for the portfolio companies of Berkshire Hathaway are unreported under GAAP, but they may be as important or more important than the reported dividend income. If the portfolio companies deploy their retained earnings effectively, which Buffett would measure as creating at least $1 of value for every dollar invested, Berkshire's investment will continue to grow without any extra work on Berkshire's part. So effectively deployed retained earnings are a huge part of what make our investments successful. My next takeaway covers one of the more effective ways to use retained earnings, and that is share buybacks. Warren and Charlie don't often repurchase shares of Berkshire Hathaway unless they believe that it will increase the per share intrinsic value of Berkshire. But last year, Berkshire spent almost $25 billion repurchasing about 81,000 Class A shares. Remember what we talked about earlier about thinking of yourself as an owner of the businesses you're invested in? Buffett makes it very clear that these repurchases increased the shareholders' ownership, aka part owners of Berkshire Hathaway, by 5.2% without them having to lift so much as a finger. Buffett illustrates this point very clearly with an example of his recent investment in Apple. From late 2016 to mid 2018, Buffett amassed a hoard of 1 billion shares of Apple, or about 5.2% of the shares outstanding. The cost for these shares was $36 billion. In the meantime, Apple has paid Berkshire $775 million per year in dividends. Additionally, Buffett sold some stock back in 2020 for a profit of $11 billion. And yet somehow, magically, Berkshire owns 5.4% of Apple stock. That's 0.2% more than they initially bought, and they even sold some shares. All of this is possible because Apple has continually repurchased their own shares. This, of course, decreases the number of shares outstanding and proportionally increases every Apple shareholder's stake in the future earnings of the business. On top of all that, and luckily for Berkshire shareholders, Buffett has been repurchasing shares over the last 2.5 years. So shareholders of Berkshire own 10% more of the future earnings of Apple than they did in mid-2018. Buffett bets that he will continue to purchase more shares of Berkshire and that Apple will continue to repurchase more of their own shares. So if you're a Berkshire shareholder, it's very likely that your ownership of Apple, and in turn, your proportion of their future earnings, will increase in the future. So good news for you. One of Warren Buffett's most praiseworthy traits is that he's always willing to admit when he's made a mistake. This year, he put his mistake, as usual, front and center, right at the top of page 2. Berkshire Hathaway had an $11 billion write-down, and he claims full responsibility for it. He goes on to explain the situation, what he was thinking, and why it was clear that it was an investment mistake. And he explains it in such a way that it's clear enough for even a non-business person to understand what's going on. He says plainly, Berkshire purchased Precision Castparts, and I paid too much for the company. See, he takes personal responsibility for it. He doesn't blame the company or the management of Precision Castparts. In fact, he praises the company as best in class and counts himself lucky to have such a passionate manager at the helm of the company. Buffett was simply too optimistic about the future earnings potential of the company. The business earns good returns on assets, but he misjudged the average amount of future earnings the business would produce. So he paid too much for it, plain and simple. He failed to accurately predict the future of the aerospace industry, which is the sector that has most of Precision Castparts' customers. He made a business mistake and paid too much money for a good business. It's a reminder that price does matter when seeking exceptional investment returns. It's also a reminder that we want management to admit mistakes as readily as they're able to make good investment decisions. Warren Buffett writes the best annual reports, and I'm always excited to dig into them every year. There's so much wisdom packed into this 14-page letter, and it's amazing that Buffett has been able to continually provide value letter after letter, year after year. Buffett's letters are a masterclass on both business and how management should communicate to their shareholders. While researching companies, if you find a management that communicates like Buffett, you better pay attention. The sad part is that most managers do not put in the effort that Buffett does. Buffett cares that his shareholders understand what's going on with the business, and most others probably don't. Some of the best business books ever written are simply compilations of Buffett's annual letters. Reading these letters every year gives us the perfect time to reflect on the lessons and timeless investment advice from one of the greatest businessmen and investors of all time. It's a little holiday and treat to investors every year when Buffett releases his annual letters. A quick note about the annual meeting, it'll take place online on May 1st in Los Angeles. So that's right, Charlie will be there this year, unlike last year. So I'm really looking forward to that, and I hope you watch it as well. If you enjoyed my key takeaways in this video, you'll probably enjoy my key takeaways over here about Mohnish Pabrai's new investment philosophy. If you like this video, please like the video and subscribe to the channel. I really appreciate you watching this all the way to the end. Thank you so much, and I will see you next time.